Well, the monetary policies that have been put in place all around the world to contain inflation have been doing their job, which is to slow the economies down, slow demand so that there's less upward pressure on prices. Now, the World Bank's assessment about overly cautious, I think, concerns the downward risks in the forecasts for various economies. Here in the United States, we have had extraordinarily strong labor markets, extraordinarily strong employment growth. We've had a very long stretch of unemployment well below what was normally considered the natural rate of 4%. In fact, we've barely come up to 4% after an extended period below that. So the U.S. is actually doing quite well. Europe is also doing well in the sense that they are able to lower their inflation much closer to target, and the ECB has decided that it is time to ease their policy. And the difficulty here in the United States is that the Fed and most economists just aren't convinced that we are decidedly headed toward 2% target of inflation. Now, one thing to keep in mind is that while high interest rates are a pain for consumers, especially if you're going to buy a home or buy a car on financing terms, one good thing that economists always point out about high interest rates is that they force businesses to prioritize their investments. That means only the best investments get funded, which means the most productive investments. And going forward, that means higher productivity for the economy and higher real wages and higher salaries for people who are working for these companies. So in the long run, we will have some benefits that come from these high rates. It's unfortunate that so many people right now are suffering a lot of pain in trying to buy homes and buy automobiles.